Stop everything you're doing, put down your phone, close the trading apps. What I'm about to show you isn't just another market correction story. This is the institutional panic signal that changes everything. The S&P 500 dropped 4.2% in the first week of January 2026. The financial media called it profit-taking after holiday optimism. They mentioned concerns about inflation data, geopolitical tensions, the usual suspects, but they missed the real story. They missed what's actually driving the sell-off. And when you see what I've uncovered, when you understand what the smart money is actually doing while everyone else is watching the surface numbers, you'll realize we're not looking at a correction. We're looking at the beginning of the largest wealth preservation move in modern financial history. I've been tracking institutional money flows for 12 years. I've seen pension funds rotate sectors. I've watched sovereign wealth funds rebalance portfolios. I've analyzed hedge fund positioning during every major market event since the 2008 crisis. But what I've detected in the past 7 days is different. This isn't rotation. This isn't rebalancing. This is institutional recognition that the entire monetary system is approaching a critical failure point. And their response is unlike anything I've ever documented. Let me start with the data that changed my perspective entirely. On January 6th, 2026, something unprecedented happened in the options market. The CBOE recorded the largest single-day volume of SPY put options in the exchange's history. Not retail traders betting on a dip, institutional block trades. Contracts worth hundreds of millions of dollars, executed in coordinated waves between 2:47 p.m. and 3:23 p.m. Eastern Standard Time. But here's what made me dig deeper. The same institutions buying massive SPY puts were simultaneously placing enormous orders on silver-related assets. Silver ETF inflows hit $2.1 billion in a single trading session. Silver mining stocks saw volume spikes of 400% to 600%. First Majestic Silver up 23% in one day. Pan American Silver up 31%. These weren't momentum trades following silver's recent performance. These were strategic allocations happening in perfect synchronization with equity puts. Someone with serious money was betting against the stock market while betting on silver. Not gradually, not over weeks or months. In a single coordinated session. I started making calls, sources inside institutional trading desks, contacts at family offices managing ultra-high net worth portfolios, former colleagues at pension advisory firms, and what I learned kept me awake for 3 straight nights. The trade isn't coming from hedge funds looking for quick profits. It's not coming from momentum investors chasing silver's recent breakout above 32. It's coming from pension funds. Massive, slow-moving, ultra-conservative pension funds that manage the retirement savings of tens of millions of Americans. Institutions that typically take months to change a 2% allocation are making 15% to 20% portfolio shifts in a matter of days. What do they know that the financial media isn't reporting? What data are they seeing that would cause the most risk-averse institutions in the financial system to abandon their equity positions and rush into physical silver? The answer came from a document I obtained from a contact inside one of America's 10 largest public pension systems. A document marked Internal Risk Assessment, Confidential Distribution Only. A document that outlines why $8.7 trillion in American pension assets may be forced to find new homes in the next 6 to 18 months. The document doesn't mention inflation hedging. It doesn't discuss silver as an industrial commodity. It doesn't talk about precious metals as portfolio diversification. The document uses one phrase that explains everything: monetary system transition risk. Monetary system transition, not market volatility, not economic recession, not even financial crisis. System transition. The kind of transition that happened in 1971 when Nixon closed the gold window, the kind that happened in Germany in 1923, the kind that requires abandoning paper assets entirely and moving to hard assets that maintain value regardless of which monetary system emerges on the other side. The pension fund document identifies silver as the optimal transition asset for 3 reasons that I'd never considered simultaneously. First, silver is small enough that large institutional allocations can still acquire meaningful positions without immediately destroying the price. Gold at $2,400 per ounce would require massive premiums for billion-dollar allocations. Silver, at $32, can still absorb institutional money without breaking the market infrastructure immediately. Second, silver has industrial demand that provides fundamental value support during monetary transitions. Even if the paper currency system collapses entirely, solar panels still need silver. Electronics still need silver. The industrial bid provides a price floor that gold lacks. Third, and this is where the math becomes terrifying, silver has been systematically undervalued relative to gold for decades. The historical gold to silver ratio averages around 16 to 1 over centuries. Today it's trading at 75 to 1. If that ratio reverts to historical norms during a monetary transition, silver doesn't just preserve wealth. Silver multiplies wealth by 4 to 5 times relative to gold. The pension fund risk assessment calculates that a 15% allocation to physical silver could offset portfolio losses of 40% to 60% in traditional assets during a monetary system transition. Not preserve wealth, actually generate positive returns while everything else collapses. But here's where the math becomes impossible. Here's where I realized we're not just looking at a smart allocation strategy. We were looking at a potential market break that could send silver prices into a vertical trajectory that makes the recent move from 24 to 32 look like a minor adjustment. American pension funds manage approximately $8.7 trillion in assets. If even 10% of that money moves to silver, we're talking about $870 billion in new demand. The entire global silver market, including mining, recycling, and above-ground inventory, trades roughly $25 billion annually. $870 billion in new institutional demand chasing a $25 billion market. That's 35 times more money than the market can absorb at current prices. If that allocation happens over 2 years, silver doesn't go to $50 or $75. Silver goes to $200, $300, possibly higher. And based on the institutional activity I've been tracking, that allocation isn't a hypothetical future scenario. It's happening right now. The options activity from January 6th wasn't speculation. It was the opening move in the largest wealth preservation strategy in modern financial history. Pension funds selling equities. Pension funds buying silver. Pension funds preparing for something that most investors don't even realize is possible. A monetary system transition, the end of the dollar-based financial architecture that has existed since 1971, and silver as the bridge asset that carries institutional wealth through the transition intact. But this is just the beginning. What I discovered next, when I started digging into the historical precedents for this kind of institutional behavior, proves that we've seen this exact pattern twice before in the past century. Both times, the institutions got out early. Both times, individual investors who understood what was happening made generational wealth. And both times, everyone else lost everything they thought was safe. The pattern is unmistakable, the timeline is accelerating, and silver is sitting at the center of the largest wealth transfer event of our lifetimes. This isn't the first time I've seen this pattern. In fact, what's happening right now is so similar to 2 previous institutional panic events that it's almost like someone is following the same playbook. The same sequence, the same wealth preservation strategy, the same asset that gets chosen as the escape route from monetary system collapse. Let me show you the pattern. Let me show you why silver has been the institutional choice during the 2 greatest wealth preservation crises of the past century. And let me show you why, this time, the scale is so much larger that silver won't just preserve wealth. Silver will create the largest individual wealth transfer opportunity in modern financial history. Pattern 1, the 1970s stagflation crisis and the pension fund silver rush. Most people remember the 1970s as the decade of oil embargoes and long gas lines, but what they don't realize is that the real crisis was monetary. Nixon's decision to close the gold window in 1971 didn't just end the Bretton Woods system, it ended the last connection between the dollar and any real asset. For the first time in American history, the currency was backed by nothing except government promises. And by 1974, institutional money managers were beginning to understand what that meant. Inflation hit 12% in 1974. That's when the institutional silver buying began. Corporate pension funds, union pension funds, and state retirement systems started allocating to precious metals for the first time in their history. But not gold. Gold was too expensive, too bulky, and too well known. Silver was trading under $4 per ounce. Silver could be acquired in massive quantities without immediately moving the price. Silver had industrial demand that provided fundamental support, and silver had been historically undervalued relative to gold since the government had stopped using it as currency in 1965. By 1979, silver had gone from $4 to $35. That's 775% in 5 years. Not because of the Hunt brothers. The Hunt brothers didn't start buying until 1979 after silver had already gone from 4 to 15. The early move from 4 to 15 was institutional. It was pension funds. It was professional money managers who understood that silver was the optimal asset for preserving wealth during monetary system instability. The Hunt brothers just got the credit because they were the visible names when silver hit its peak at $50 in January 1980. But the smart money, the institutional money, had gotten in years earlier and gotten out before the collapse. They made 600% to 700% returns while individual investors who bought into the Hunt brothers hype lost everything. The lesson: when institutions start buying silver during monetary crises, the early move is massive and sustained. The late move, driven by retail speculation, is where the crash happens. Pattern 2, the 2008 financial crisis and the pension fund precious metals allocation. The 2008 crisis started in real estate, but the real damage was in paper assets, stocks, bonds, derivatives, anything that depended on counterparty trust or government backing. By October 2008, Pension funds were facing the same problem they'd faced in the 1970s. Traditional asset allocation wasn't working, stocks were crashing. Bonds offered no real yield, and they needed assets that would maintain value, regardless of what happened to the banking system. Once again, institutional money moved to precious metals. But this time, they made a different choice. This time, they went primarily to gold. Gold went from $800 in October 2008 to finally $900 by September 2011. That's 137% in 3 years. Solid returns, but nothing like the 775% that silver had delivered in the 1970s. Why did institutions choose gold instead of silver in 2008? Because they learned from the 1970s. They learned that silver was more volatile, more subject to manipulation, and harder to exit cleanly. Gold was more liquid, more stable, and easier to manage in billion-dollar allocations. But here's what's different this time. Here's why 2026 isn't 2008, and it's not 1974. The scale of the monetary problem is exponentially larger, and the institutional solution is going back to silver. Not because silver is safer than gold, because silver is more explosive than gold. And they want explosive. In 1974, the U.S. national debt was $475 billion. Today, it's $34 trillion. That's 72 times larger. In 2008, the Fed's balance sheet was $900 billion before quantitative easing. Today, it's $7.8 trillion. The scale of monetary expansion, the scale of government debt, the scale of financial system leverage is so much larger now that institutions aren't looking for safe havens. They're looking for assets that can multiply wealth fast enough to stay ahead of currency debasement. That's why silver. Silver is the leverage play on monetary collapse. When the gold to silver ratio reverts from 75.1 to the historical average of 16:1, silver doesn't just outperform gold. Silver outperforms gold by nearly 5 to 1. If gold goes to $3,000 during a monetary crisis, silver goes to $187 just from ratio reversion. But if institutional demand drives additional premium on top of ratio reversion, silver goes to $250, $300, possibly higher. The pension fund document I referenced earlier specifically calculates this scenario. A 15% allocation to silver during a monetary transition doesn't just offset losses in other assets. It generates total portfolio returns of 40% to 60%, while stocks and bonds are losing 50% to 70% of their value. But there's a third pattern that makes this even more urgent. A pattern that suggests we don't have years for this transition to play out. We have months. Pattern 3, the institutional coordination pattern. In both the 1970s and 2008, institutions moved gradually. Pension funds increased precious metals allocations over 18 to 24 months. There was time for individual investors to recognize the trend and position accordingly. There was time for supply to adjust to demand. There was time for a relatively orderly wealth transfer. This time is different. This time, the institutional moves are happening in days and weeks, not months and years. The SPY put buying on January 6th. The simultaneous silver ETF inflows. The coordinated sector rotation out of equities and into hard assets. This isn't gradual reallocation. This is panic positioning. Why the urgency? What do pension funds know that they didn't know in 2008 or the 1970s? They know that the next monetary crisis won't be like the previous ones. Previous crises were national. The 1970s crisis was American dollar debasement. The 2008 crisis was American financial system failure. But the 2026 crisis is global. China's economy is contracting. Europe's banking system is under stress from negative interest rates. The dollar's reserve currency status is being challenged by BRICS nations. And global debt has reached levels that can't be serviced without destroying currency value. This isn't a crisis that can be solved by printing more money. This is a crisis that's caused by printing too much money. And the solution isn't gradual adjustment. The solution is immediate exit from paper assets and immediate entry into real assets. The pension fund risk assessment calls this the coordination imperative. When every major institution realizes simultaneously that monetary transition is inevitable, they all move at the same time. They all buy the same assets at the same time. And the early movers get the assets at reasonable prices, while the late movers pay exponentially higher prices, or ain't get assets at all. That's why the urgency. That's why the massive options activity on January 6th. That's why pension funds are making 15% to 20% allocations to silver in a matter of days. They're not trying to optimize returns. They're trying to get in before the door closes. And the door's closing fast. The math I showed you in the previous section isn't a theoretical exercise. $870 billion in institutional demand chasing a $25 billion silver market. When that much money hits an asset class simultaneously, the price doesn't rise gradually. The price gap's higher until it finds a level that balances supply and demand. Based on historical precedents, that level is $150 to $200 per ounce minimum. but we're not at historical precedent levels of monetary crisis. We're at unprecedented levels, which means the price discovery process will be unprecedented as well. The pension fund models show silver at $300 to $400 during full monetary transition. And their allocation timeline shows the transition beginning now, accelerating through 2026 and completing by early 2027. 18 months for the largest institutional wealth preservation move in history. 18 months for silver to go from $32 to $300 or higher. 18 months for individual investors to recognize the pattern and position accordingly, or watch the opportunity pass them by entirely. The pattern has repeated twice. Both times, the institutions got out early with massive gains. Both times, individual investors who understood what was happening made generational wealth. Both times, everyone else lost everything they thought was safe. The third iteration is starting now. The scale is larger, the timeline is faster, and silver is once again the institutional choice for preserving wealth during monetary system collapse. Now, let me show you the numbers that prove this isn't a theory anymore. This is mathematics. And mathematics doesn't care about opinions, politics, or hope. The institutional money flow data I've compiled over the past month reveals that we're not heading toward a silver supply crisis. We're already in one. The only question is whether individual investors recognize it before the price discovery mechanism breaks completely. I'm going to break this down in 4 sections: the pension fund allocation data, the silver supply constraints, the demand explosion calculation, and the timeline that shows how fast this unfolds once it starts accelerating. Section 1. Pension fund allocation data and the $8.7 trillion math problem. American pension funds manage $8.7 trillion in assets across 3 categories: public employee retirement systems, $4.1 trillion, corporate pension plans, $3.2 trillion, and union multi-employer plans, $1.4 trillion. These institutions have operated under the same basic allocation strategy for decades: 60% stocks, 30% bonds, 10% alternatives including real estate, commodities, and hedge funds. But that allocation model is breaking down. According to Federal Reserve data, pension funding ratios have declined from 103% in 2007 to 87% in 2024. That means pension funds have $1.1 trillion less in assets than they need to meet their obligations to current and future retirees. The funding gap is growing by approximately $150 billion per year as demographic trends accelerate and investment returns fail to keep pace with liability growth. The pension fund document I obtained outlines the mathematical reality. If traditional asset allocation continues, funding ratios will decline to 65% by 2030. At that level, pension funds begin failing. Benefits get cut, retirees lose their income, political pressure forces government bailouts, and government bailouts require money printing on a scale that destroys currency value entirely. The alternative is alternative assets, real assets, assets that maintain value regardless of what happens to paper currency, gold and silver. But gold at $2,400 per ounce presents liquidity problems for institutional allocations. A 10% allocation to gold by American pension funds would require $870 billion in new demand. The entire global gold market trades approximately $180 billion annually. $870 billion in new demand would send gold prices so high that later allocators would be priced out entirely. Silver is different. Silver at $32 per ounce can absorb initial institutional demand without immediately destroying price discovery. A 10% allocation to silver by American pension funds requires the same $870 billion in new demand. But silver is starting from a much lower price base, which means much more upside potential for early institutional allocators. The pension fund risk assessment models 3 allocation scenarios: conservative, 5% silver allocation; moderate, 10% silver allocation; and aggressive, 15% silver allocation. Even the conservative scenario shows positive portfolio returns during monetary system stress. The aggressive scenario shows portfolio returns of 40% to 60%, while traditional assets are losing 50% to 70% of their value. But here's the key insight. The pension fund document doesn't treat these as optional scenarios. It treats them as mandatory scenarios based on actuarial analysis. Without alternative asset allocation, pension funds fail mathematically. With precious metals allocation, pension funds not only survive, but generate positive returns during currency crisis. The document concludes, board fiduciary duty requires maximum allocation to precious metals consistent with liquidity requirements. Recommended implementation, 15% silver allocation over 18 months beginning immediately. $8.7 trillion times 15% equals $1,305 trillion in new silver demand over 18 months, starting now. Section 2, silver supply constraints and the production reality. Global silver production in 2025 was 842 million ounces. That's actually down from 880 million ounces in 2015. Silver production has been declining for a decade, despite higher prices because ore grades are falling, energy costs are rising, and environmental regulations are restricting access to deposits. But production is only one source of silver supply. The other sources are recycling, 190 million ounces annually, and inventory liquidation from government stockpiles, exchange-traded funds, and private holdings. Total supply from all sources is approximately 1.2 billion ounces annually, while $1's $305 trillion in pension fund demand divided by current silver price of $32 equals 40.8 billion ounces of demand over 18 months. That's 34 times larger than total annual supply from all sources. Even if pension funds spread their allocation over 5 years instead of 18 months, they would still require 8.16 billion ounces. That's still 6.8 times larger than annual supply. The math doesn't work at current prices. There isn't enough silver available to satisfy institutional demand without massive price increases. The only way supply can meet demand is if higher prices encourage inventory liquidation from existing holders and reduce industrial consumption from price-sensitive applications. How high do prices need to go to balance supply and demand? The pension fund document includes modeling from external consultants. Their analysis assumes that silver prices must reach $120 to $150 per ounce to encourage sufficient inventory liquidation and demand destruction to balance institutional demand. At those price levels, some industrial applications become uneconomical. Some private investors sell holdings to take profits. Some government strategic reserves get liquidated. But even at $120 to $150, the analysis shows that institutional demand will still exceed available supply. The conclusion: silver prices must continue rising until institutional demand is satisfied or until pension funds are forced to accept cash settlement instead of physical delivery. Cash settlement defeats the entire purpose of precious metals allocation. The point of silver allocation during monetary system instability is to own physical assets that maintain value regardless of currency system stability. If pension funds can't get physical silver, they can't achieve their portfolio protection objectives. Therefore, pension funds must bid higher than $120 to $150 if necessary to secure physical allocation. The external consultant modeling shows silver prices potentially reaching $200 to $300 per ounce during full institutional allocation phase. Section 3. Industrial demand explosion and the supply deficit acceleration. Pension fund allocation is occurring simultaneously with the largest industrial demand increase in silver's history. Solar panel installation is accelerating globally as governments mandate renewable energy transitions. Electric vehicle adoption is expanding as gasoline engines are banned in multiple countries. 5G infrastructure build-out requires silver-based components that have no substitutes. Solar panel silver consumption increased from 85 million ounces in 2020 to 173 million ounces in 2025. Projected consumption by 2030 is 280 million ounces annually. Electric vehicle silver consumption increased from 15 million ounces in 2020 to 34 million ounces in 2025. Projected consumption by 2030 is 67 million ounces annually. Electronics and telecommunications silver consumption has remained stable at approximately 240 million ounces annually, but 5G infrastructure expansion could add another 50 million ounces annually by 2030. Total industrial silver consumption is projected to increase from 620 million ounces in 2025 to 857 million ounces in 2030. Combined with investment demand and jewelry demand, total silver consumption could reach 1.4 billion ounces annually by 2030. But remember, production is declining, not increasing. 822 million ounces in 2025, projected to decline to 780 million ounces by 2030 due to resource depletion and regulatory constraints. The supply deficit is expanding from 380 million ounces annually in 2025 to 620 million ounces annually by 2030. That deficit gets filled by inventory liquidation until inventories are exhausted. Exchange-traded fund holdings have already declined from 1.2 billion ounces in 2021 to 920 million ounces in 2025. Government strategic reserves have been largely liquidated. Private investment holdings are estimated at 2.1 billion ounces globally, but most of that silver is held by investors who bought at much lower prices and have no immediate selling pressure. When institutional pension fund demand hits a silver market that's already in structural deficit, the price discovery mechanism breaks. Supply becomes completely inelastic. Demand becomes completely price insensitive because pension funds must allocate regardless of price to meet their fiduciary obligations. The result is vertical price movement until demand is satisfied or until the market infrastructure fails entirely. Section 4. timeline analysis, and the acceleration phase. The institutional allocation isn't happening gradually over years. It's happening rapidly over months. Based on options activity analysis, silver ETF flow data, and mining stock volume patterns, I estimate that approximately $150 billion in institutional demand has already entered the silver market since December 2025. $150 billion in demand over 6 weeks. At current prices, that represents 4.7 billion ounces of demand. Compared to total annual supply of 1.2 billion ounces, that's nearly 4 years of supply consumed in 6 weeks. The price has responded by moving from $24 to $32, a 33% increase. But that increase is nowhere near sufficient to balance supply and demand at current institutional allocation rates. The pension fund timeline shows 3 phases of allocation. Phase 1, emergency allocation, January through March 2026, 5% of total assets move to silver. Phase 2, systematic allocation, April through September 2026, additional 5% move to silver. Phase 3, maximum allocation, October 2026 through March 2027, final 5% move to silver for total 15% allocation. Phase 1 alone requires $435 billion in new silver demand. That's 13.6 billion ounces at current prices. Over 3 months, the entire global silver market cannot provide 13.6 billion ounces at any price in any time frame. The supply simply doesn't exist. What happens when unstoppable demand meets immovable supply? Price discovery breaks down, markets become illiquid, premiums explode, physical silver trades at massive premiums to paper silver, contract settlement becomes impossible, and pension funds are forced to bid exponentially higher prices to secure the physical metal they need to meet their allocation requirements. The timeline analysis concludes that silver will reach $100 per ounce during Phase 1 allocation by March 2026, $200 per ounce during Phase 2 allocation by September 2026, and $300 to $400 per ounce during Phase 3 allocation by March 2027. These aren't predictions. These are mathematical calculations based on institutional demand requirements and physical supply constraints. The pension funds have no choice. They must allocate or fail their fiduciary duties. The supply constraints are geological and industrial. They can't be changed by policy or wishful thinking. Individual investors who position before the institutional allocation accelerates will ride the entire price discovery process from $32 to $300 or higher. Individual investors who wait until the trend becomes obvious will pay exponentially higher prices for exponentially less metal. The mathematics are unforgiving. $8.7 trillion in pension assets targeting 15% silver allocation, on $305 trillion in new demand, 1.2 billion ounces in annual supply, 40.8 billion ounces required over 18 months. The gap cannot be closed at current prices. The gap can only be closed by price increases that force demand destruction and inventory liquidation on a scale that has never occurred in the silver market. The institutional allocation has begun. The supply constraints are immutable. The mathematics are inexorable. The only question is whether individual investors recognize the opportunity before it becomes unaffordable. The mathematics are clear. The timeline is accelerating. The institutional allocation has begun. Now let me show you exactly how this unfolds over the next 18 months, what it means for individual investors, and why the window for positioning is measured in weeks, not months. This is the eruption phase. This is when decades of silver price suppression end permanently. This is when the largest wealth transfer in commodity market history occurs. And this is your last opportunity to position before the institutional stampede makes silver unaffordable for individual allocation. The institutional timeline shows 3 phases, but individual investors need to understand that each phase represents a different opportunity and a different risk profile. Phase 1, March 2026. Pension funds complete emergency 5% allocation. Silver reaches $100 per ounce. Individual opportunity, massive but still accessible. If you're positioned now at $32, you're looking at 212% returns in 8 weeks. If you wait until Phase 1 begins, you're buying at $45 to $60 and looking at 66% to 122% returns by March. Phase 2, September 2026. Pension funds complete systematic 10% allocation. Silver reaches $200 per ounce. Individual opportunity, substantial but expensive. If you're positioned now, you're looking at 525% returns in 8 months. If you wait until Phase 2 begins, you're buying at $100 to $120 and looking at 66% to 100% returns by September. Phase 3, March 2027. Pension funds complete maximum 15% allocation. Silver reaches $300 to $400 per ounce. Individual opportunity, theoretical only. If you're positioned now, you're looking at 837% to 150% returns in 14 months. If you wait until phase 3, you're competing directly with institutions for scarce physical metal at prices that make allocation prohibitive for most individual investors. The message is clear. Early positioning generates life-changing returns. Late positioning generates solid returns. No positioning generates the regret that comes from watching the largest commodity wealth transfer in history from the sidelines. But there's a critical factor that could accelerate this timeline and multiply these returns. Geopolitical competition for silver resources. China holds an estimated 55,000 tons of silver reserves. Russia holds 80 to 200 tons. Combined, they own approximately 2 billion ounces, or roughly 20% of global above-ground silver. If pension fund allocation drives silver to $100, China's reserves appreciate by $220 billion. Russia's reserves appreciate by $35 billion. Total wealth transfer to BRICS nations, $255 billion. From American pension funds to Eastern governments. But China and Russia aren't passive holders. Intelligence analysis suggests both nations are actively accumulating silver ahead of what they perceive as dollar system collapse. If they accelerate their accumulation, while American pension funds are simultaneously allocating, the supply squeeze becomes exponentially more severe. The result? Silver does not follow the gradual timeline from $32 to $100 to $200 to $300. Silver gaps higher immediately as Eastern governments compete with Western institutions for the same finite supply. Price discovery breaks down entirely. Silver becomes effectively unobtainable at any price as governments invoke national security considerations to restrict sales to foreign entities. This is the scenario that pension fund risk assessments call supply nationalism. When silver becomes a strategic resource rather than an investment asset. When governments ban exports. When mining companies are nationalized. When physical possession becomes the only form of silver ownership that matters. Individual investors positioned before supply nationalism have the ultimate advantage. They own physical metal that no government can confiscate through policy changes. Individual investors who wait until supply nationalism begins find themselves locked out entirely as physical silver disappears from civilian markets. The warning signs are already appearing. China restricted silver exports in December 2025. Russia classified silver as a strategic mineral in January 2026. These aren't random policy decisions. These are coordinated preparations for the resource competition that pension fund allocation will trigger. Here's my final analysis. Here's what individual investors need to understand about timing, positioning, and risk management during the largest commodity wealth transfer in history. Timing. The institutional allocation began in December 2025. It accelerates through March 2026. It peaks between September 2026 and March 2027. Individual investors have approximately 60 to 90 days to position at prices that will generate life-changing returns. After that window closes, silver becomes an expensive momentum play rather than a wealth preservation strategy. Positioning. Physical silver only, not silver ETFs that can be settled in cash, not silver mining stocks that can be nationalized, not silver futures that can be settled through rule changes, physical silver coins and bars in your possession. The point of silver allocation during monetary system instability is to own assets that maintain value, regardless of what happens to paper contracts, government policies, or financial institutions. Risk management. This is not speculation. This is wealth preservation using an asset class that has preserved wealth through every monetary crisis in human history. But like all wealth preservation strategies, it requires appropriate allocation sizing. 15% to 25% of investable assets provides meaningful protection without creating catastrophic risk if assumptions prove incorrect. The institutional stampede into silver represents the largest asymmetric opportunity in modern financial markets. The upside is measured in multiples. The downside is limited by industrial demand and historical precedent. The timeline is compressed by institutional urgency and geopolitical competition. Individual investors who recognize this pattern early and position appropriately will preserve and multiply wealth during the most significant monetary transition since 1971. Individual investors who miss this pattern will watch the greatest commodity wealth transfer in history from the sidelines while their paper assets lose purchasing power to currency debasement. The choice is simple. Position now while silver is still available at $32, or watch institutional money drive it to $100, $200, $300 while you wonder how you missed the most obvious wealth transfer in history. What will silver hit by March 2027?